Welcome, everybody. Thank you for coming to the We Are seminar. Just a little bit of housekeeping. The seminar goes for 1 hour, and Leslie, our speaker, she would like questions to come during the talk as normal in academic seminars, as opposed to leaving them until the end. So maybe particular lengthy questions might be left until the end, but the usual questions, Leslie is very happy to take them. And then after the official finish of the seminar, we will have 10 minutes for networking, chat. We'll do it in breakout rooms or in the main room. We'll see how many people stay behind, but I will stay behind, Leslie will stay behind, and we will be delighted to chat with everybody. And now, so that I don't take any time from Leslie, let me introduce her to the group. Leslie Shen is with the Federal Reserve Board, and she will be presenting her paper, Risk Sharing and Amplification in the Global Financial Network. The floor is yours, Leslie.
Thanks very much, Anna. Let me share my screen. I hope you can see it well. So thanks a lot for the introduction and for giving me the opportunity to present this excellent seminar series. I will be discussing risk sharing amplification in the Global Financial Network. This is joint work with Tony Zhang, a colleague of mine at the Federal Reserve Board. So the usual Fed disclaimer applies. All right. So over the past 25 years, the financial system has become highly globalized and interconnected, and banks are central to this system. Global banks, they intermediate more than $30 trillion of cross-border capital flows annually, providing around 20% of total private credit in developed economies. And through these interactions, they play a key role in facilitating international risk sharing. At the same time, they also propagate shocks across borders, as documented in the literature and seen from the various financial crises. The literature on shock propagation and international risk sharing commonly analyzes these questions through the lens of models featuring one representative financial intermediary. However, banks form diverse and complex bilateral relationships across countries. They do both with other banks and directly with firms. So here, I'm plotting out these cross-border lending relationships based on actual data from the BIS. So on the left, sorry, I'm trying to see if I can show the pointer. Okay, on the left, illustrates the cross-border bank-to-bank relationships among 19 major developed and emerging market countries. So this makes up what we call the global interbank network. The right illustrates bank-to-firm lending relationships, making up what we call the global credit network. And these two networks make up what we call the global financial network. The relationships in this network are diverse and evolving. Okay. And the research question that we tackle in this paper is, how does this global financial network facilitate risk sharing and propagate shocks across countries and across the bank and non-bank sectors? So just to be clear, whenever I say non-bank in this talk, I mean firms or the non-financial sector. So to address this question, we first develop a structural model of the global financial network that encompasses both the global interbank and credit networks. Each banking sector solves a portfolio allocation problem in which they decide how to allocate their funding across countries and between the bank and non-bank sectors based on expected returns and characteristics of the borrower and the lenders. The model incorporates endogenous supply and demand of loans, as well as endogenous prices. So we take into account the fact that when capital flows into a country or sector, that would drive up the corresponding lending prices. Next, we estimate the model, which means that we estimate cross-border interbank and non-bank loan supply and demand curves for 19 countries from 2005 to 2019. We use balance sheet data of internationally active banks for BIS. Then using the estimated model, we conduct counterfactual exercises to quantify the extent of risk sharing, or we call insurance, provided by banks in the global financial network in response to country-specific funding shocks. So insurance is defined as the increase in funding inflows relative to the size of the shock. And we assess how this amount of insurance varies across countries and changes over time.
Leslie, I have a question on the previous slide. I'm wondering about the non-bank financial institutions, because we know there is an explosion in private credit, and everybody's talking about it's growing exponentially after the crisis. Could you comment on that? How much of that, you are looking at banks, it's very clear from your introduction, but how much are we missing in terms of credit to firms? Thank you.
Yeah, so that's a very good question. So here, as I said, we are focusing on banks, and we are also including bank to any lending from bank to non-bank financials in our analysis. And that part is incorporated in what we call non-bank. But for a lot of countries, except the major ones, these are actually not that big. For like US, several major economies, they're big, but for others, we look at they're not as big. And the reason that we're grouping them together with firms is because it's hard to get a consistent breakdown of non-bank financial versus bank, just financial non-banks in the data sets consistently across various countries. So they are actually incorporated in our analysis. Okay, so based on these steps, we have a set of findings, which I'll briefly highlight now. First, we find that there is significant heterogeneity in banks' willingness and capacity to provide intermediary services across countries. So we tease out these heterogeneities through our estimates of supply elasticities for cross-border, interbank, and non-bank lending. Greater willingness and capacity to lend to a borrower or country result in higher aggregate supply elasticities for that country. And these are the first estimates of cross-border loan supply elasticities to our knowledge.
So Leslie, just to clarify, the BIS data you use, is it the consolidated one? So are we talking about the loans that are made by the headquarters, let's say of HSBC, or by all the subsidiaries of HSBC in different countries? How do you, what kind of data cut are you using for the networks?
So we are using the locational banking statistics. So that includes, that's a kind of a residence-based data set. So the reason we do that is twofold. One is like subsidiaries of HSBC in the US, they're regulated by US regulators. And literature has shown they're more affected by monetary policy in the US. So we consider them to be a part of the US. And second, there's also literature showing that they operate more like an independent organization instead of part of the parent organization. So that's why we made this decision. And we take into account the fact that there is kind of intra-bank flows, and we don't want those to drive our results. So we take the intra-bank flows out of these flows that we're taking into account.
I see. So if HSBC, I don't know, based in London, would send some liquidity to an Argentinian subsidiary, you take that out?
Yes.
Okay.
Yes.
So I have a question regarding that last point by Helen. My prior, based on the rest of the BIS data, is that these flows are quite sizable, the ones to the subsidiaries. If you're truly interested in kind of risk sharing, wouldn't you want to incorporate them somehow in the analysis, given that especially the large banks, indeed, they transfer a lot of funds?
Yeah, so absolutely. We actually have done both, where we've taken one out and we've taken it without, just to see what difference it makes. It definitely makes elasticity kind of higher in the interbank part, but it's not drastically higher. Actually, it's not super different. But we have done like both set of analysis, but the ones that I'm showing are the ones that have taken out these intra points. All right. So second, the result is that we show that these heterogeneity in banks' willingness to lend across countries explains a variation in the amount of insurance countries receive in response to local funding shocks. So borrower countries with lower supply elasticities receive less insurance against local funding shocks because banks in the network are less willing to rebalance toward that country's banks and firms. Okay. And third, we find that supply of cross-border lending has become less elastic over the past decade. As a result, the insurance provision by banks in the global financial network has declined globally. In fact, the network now amplifies local funding shocks in the interbank network for some countries instead of providing insurance. And we provide some suggestive evidence at the end showing that the greater stringency of bank regulations is associated with this decline in global insurance. So our paper contributes to 3 strands of literature. First and foremost, it contributes to the growing theoretical and empirical literature on the role of financial intermediaries in propagating shocks. The theoretical work mostly studied this question through the lens of models featuring representative financial intermediary, and I know Helen has like one new paper that has looked actually into heterogeneity across financial intermediaries. So we think we're contributing to that set of literature. And on the empirical side, much of the literature studies propagation either between specific country pairs at the aggregate level using reduced regressions, which makes it difficult to provide systematic analysis. So we provide a quantitative framework that integrates multiple networks and countries, and thereby allows a joint analysis of shock propagation, both across countries and across the financial and non-financial sectors. And second, our paper builds on the literature that uses portfolio-based models to study asset pricing and asset allocation. This includes, in particular, the recent work on demand system asset pricing by Koji and Yogo. And we add to that literature by embedding a network structure into the model and endogenize both supply and demand for assets. Third, we contribute to the networks literature by providing structural estimates of realistic supply curves that connects endogenous interactions between financial network and credit to the non-financials. Okay, so this is going to be the outline of the rest of the talk. And next, I will highlight the key components of our structural model of the global financial network. So there are n countries in the network. Each country has a representative bank. Its lending and borrowing decisions are illustrated in this simple conceptual figure here. So each banking sector could borrow from or lend to other banking sectors through the global interbank network. It could also lend to non-bank sectors in foreign and domestic countries through the global credit network. In particular, each sector has n+1 borrowers, with +1 being like the destination countries outside of this network. So each banking sector solves an optimal portfolio choice problem in the style of Merton's portfolio problem. So the optimal portfolio of each bank can be simplified to a nested loader function as proved in Koji and Yogo's recent papers. So that means the portfolio weight that country N, banking sector, puts in country M, sector L at time t is made up of a within sector portfolio weight and a cross-sector portfolio weight. The within sector portfolio weight is a logistic function where delta in the numerator captures the desirability in lending to country M in sector L. The desirability, and the denominator here is the desirability of all potential lending opportunities in the sector. The desirability term, more precisely, is an exponential function of local currency low price, exchange rate, characteristics of the borrowers, lenders, and their bilateral relationships, and a latent term, kappa, which captures any unobserved characteristics of the loan.
So may I ask something? So it is, of course, very elegant to convert it into the functions that you are going to estimate, but I'm wondering about this Merton's portfolio choice, whether it's really applicable to decisions of a bank, because there's just banks are so different from, let's say, households who decide how to allocate their assets. They have to worry about regulatory capital. They have to worry about liquidity ratios of all sorts of things. And in the objective function that gives rise to this portfolio demand, there is nothing. It's just their wealth. That's it. They're just maximizing the return on their portfolio, risk-return trade-off. So what's your view on that? Thank you.
So that's a very good question. And why we started, how we thought about this question is we wanted to start with kind of the most straightforward kind of way to think about, this fundamental way to model how a bank would allocate assets, how it manages balance sheets. And that gives us kind of a portfolio way of looking at this question. And we want to see whether that gives us kind of results that reflects the bank capital flows that we observe in the data. And obviously, we could later on add more other considerations that bank may take into account in this decision making. But we want kind of a most baseline fundamental way to think about this question. And see how far we can get. And in the end, we actually find that based on this, we actually go very far in explaining kind of the bank capital flows that we observe in the data.
Okay, just as a follow-up comment that given that you have a structural model, we are taking your model extremely seriously in everything that follows. So you would naturally be asked to defend your model and defend the modeling choices you are making. So I think some discussion about this modeling choice would be useful in the paper.
Absolutely. Yeah, thank you. Okay, so in addition, for the cross-sector,
Leslie, we have a couple of questions.
Okay.
Hi, Leslie. One question. So here you're in the model you're presenting, you're kind of thinking about the substitution between lending to borrowers in different countries, right? You could also think about that the banks have to choose between lending in different currencies. In some emerging markets, that's a kind of a important consideration. Quite often, they would lend both in the domestic currencies or in the local currency, as you have here, and also in hard currency. So, and I think you have some data from the BIS in terms of the currency of lending. Have you thought about that a bit?
Yes, so we definitely have thought about the currency aspect, and our hope initially was we can both incorporate kind of the sector and currency decisions into the model. But unfortunately for the BIS data, you either get the currency breakdown or you get the sector breakdown. You can't get kind of a currency breakdown within the bank-to-bank lending or bank to kind of non-bank lending. So we ultimately decided that we're going to focus on kind of the sector heterogeneity, but the model can be easily used to study the question that you raised about the currency choices.
Okay. And here in this setup, you have different sectors. When you have different sectors, do you mean that the banking sector and the non-bank sector are modeled? So lending to the bank and non-bank sector are modeled in exactly the same ways?
Exactly, yes. Yeah.
Okay, then I guess.
So this is kind of the cross-sector component that I'm going to talk about. So they can.
I'll wait for the. I think I guess in that case it's very important how you define the characteristics, because they would need to capture quite a rich set of things that affect lending to different sectors. Okay, thank you.
So Leslie, you have another question from Vanya.
Yes.
I just more like kind of comments and suggestions. So I completely appreciate the complexity of introducing regulatory constraints. Kind of builds on Anna's point, which I also agree is absolutely first order here. And if you think about your introduction, you started with something happened with the global financial crisis and regulation become more stringent. So I presumably, I'm guessing you have time period that includes prior and post the global financial crisis. So in order to explain the data without regulatory constraints, without structural breaks in the regulatory constraints, it must be some of your characteristics variables are picking up the regulatory changes. So my question would be later on if you can point out which characteristics do you think are soaking up these kind of regulatory changes that we know are important but not explicitly modeled here. My second point is, I don't know whether you're careful with the data regarding the ring fencing in the UK. So, we have, of course, UK is an important player here. And this changed a lot, effectively, the way UK banks operate domestically and abroad. So cross-country flow were impacted quite a bit with ring fencing. And the second point is, because of these regulatory changes, a lot of the global banks made strategic decisions with respect to subsidiaries. So it might be useful to exploit the within subsidiary flows to tell us something about the change over time. So my prior is that maybe what you're seeing is that now they terminated some subsidiaries across the world, or maybe flows within the subsidiary decreased. Is there a kind of substitutions towards lending across different banks as a result of small role played by subsidiaries, because maybe some global banks decided to shut down operations in certain parts of the world? There were interesting structural breaks in the data that are not explicitly modeled, but you're telling me explain most of the variation, so it must be soaked up by something. So this is kind of the shortcoming of this super reduced form style of modeling is, right, what is this thing soaking up, this variation that clearly is not modeled explicitly here?
Yeah, okay. Thanks for the question. So the first question about regulatory constraints. So we have in our characteristic variables an index of regulatory kind of macroprudential policy index that captures the stringency of regulations across countries. And we also have an analysis where we kind of interact this regulation with the price and seeing how changes in regulatory effects and the price elasticity with respect to loan supply. And this, I'm going to show some specific evidence at the end, so how this changes in regulatory stringency actually is highly correlated with the changes in insurance and elasticities that we have. And so we actually have a follow-up project where we explicitly look into how bank regulations have impacted bank lending from financing and the welfare implications of that. So I think absolutely I agree with you that regulation is of first order here, and we kind of right now we are taking into account of regulations in the characteristics, and we're obviously going to do more work to explore that aspect. And the second about, we can definitely look more into the kind of the subsidiary intrabank flows to explore any structural breaks. And I think it is important, and we can definitely do more work on that front. Okay, so back to this. In addition, we not only allow banks to decide whether they want to lend to the US versus Japan within each sector, but also cross sectors to banks or firms. So a cross sector portfolio weight is also logit, and bank sector N's portfolio weight in sector L is going to depend on the total desirability of loans within sector L, as well as some sector fixed effects and the latent supply term. And the lambda term here captures the substitution between sectors. So it should be between 0 and 1, as lending to one particular sector becomes more expensive, the bank will want to shift away from that sector. Okay. In addition, we introduced two elements in our model that are novel relative to the existing literature. First, we embed an interbank network into the model. And as shown here, the total AUM, asset under management of the banking sector in each country N period T, is the sum of funding from domestic sources, such as bank deposits, and funding from international transfers, which is endogenous to assets in the banking sector of each country. as well as the portfolio allocation problem of each bank. So as more capital flows into a country or sector, prices will go up. That will feed back into the amount of AUM in not only this banking sector, but also all banks in the network. And this element is novel relative to existing work, which usually takes AUM in the system as exogenously given. And second, we allow demand for loans to adjust endogenously. So this means that we also incorporate decisions of, say, a firm like Google about whether it wants to borrow from a bank in the US or a bank in the UK. So the quantity of loans demanded adjusts logarithmically with prices, characteristics of the borrower country, and time fixed effects. And we keep our demand specification simple by design because the focus of our analysis is really on the supply side. Okay. And these last three equations are what we need to close the model. The top two are market clearing conditions in the bank and non-bank sector. And the third is an exchange rate determination equation. And ultimately, the banking sector AUM and lending prices are endogenous and must adjust to make sure that the market value of loans supplied equals the market value of loan demanded in all sectors. So now I have briefly walked through the structure of our model. Let me give an overview of our empirical strategy for estimating and analyzing it. We first collect data on all the exogenous variables and estimate loan supply and demand curves using the data. So we collect data on the total value of loans in interbank and non-bank sectors in each country, which allows us to construct portfolio weights, the amount of domestic funding, and characteristic variables that drive lending across countries like GDP and distance between countries. We then estimate the supply curve parameters using the data that gives us the beta, theta, and lambdas that drive portfolio shapes. It also allows us to back out this latent demand, latent supply, which captures incentive for lending that are not accounted by the observable characteristics. And in a similar fashion, we estimate demand curves for loans. And based on the supply and demand curves, we then conduct counterfactual analysis to study the extent of insurance provided by the global financial network in response to local funding shocks. So our main data for estimating is the restricted VIS locational banking statistics. So this data is uniquely appropriate for our study because it contains information that perfectly maps to our framework. It includes cross-border and local claims of banks domiciled in reporting countries, broken down by reporting and counterparty country pairs, as well as by counterparty sector. So for example, we can observe how much the US banking sector is lending to the German banking sector and the German non-bank sector in each particular quarter. For the characteristic variables, we use characteristics of borrower, lender, and their bilateral relationships to capture differences in expected returns and risks across countries. And that includes GDP, GDP per capita, inflation, stock price volatility, monetary policy rates, and index of macroprudential regulation, as well as bilateral distance and bilateral trade exposures. For prices, we use interbank lending rate for interbank lending and prime rate for non-bank lending, and we also include exchange rates. So our final sample consists of 19 countries, including advanced economies and 4 emerging markets. Our sample period runs from 2005 to 2019. Okay. So now I'm going to provide an overview of how we estimate loan supply and demand curves. Given this is a relatively short presentation, I will not go through the step-by-step procedure and instead focusing on providing the intuition. The nested logit structure of our model yields 2 convenient estimation equations for bank loan supply. The first equation here estimates loan supply within each sector. So the log portfolio weight that country N puts in country M, sector L, normalized by the weight in the outside asset is a linear function of loan price, characteristics of loans, and the latent supply curves, as the supply terms. The second equation estimates the cross-sector loan supply. Yes. Question.
Hi, just one clarification question. What does this loan supply curve imply for the competition structure? So can you back up markups from this for the banking sector? Is there competition? Because I guess from the this kind of logistic function for supply, usually it's used in IO, I guess, for demand, where you have atomistic households with just heterogeneous preferences. But I guess for banks, they would have quite a different competition structure, and I would expect some different markups. I was just wondering, can you back out markups from this? Are there any markups, or are they zero in this setting? How does it work?
So this is a more simple structure where we are, if you're just thinking about portfolio allocation problems, and I don't think that we are that we're not taking into account a particular like monopolistic competition or anything like that. But that's a very good point. When I will think more about the competition structure of the banks.
So I should think of the banks as very small banks in this setting. So they're all okay.
We're not differentiating between large banks and small banks. This is kind of like, no, we're looking at the country level, at the aggregate level.
Mm-hmm. Okay, thanks.
Okay, so to estimate these supply curves, we face the classic endogeneity concern, right? Higher capital inflow can drive up prices, which will lead to an upward bias of the coefficient on price. And to address this problem, we followed IO literature and used a structural model to construct implied instruments for lending prices and exchange rates. The main idea of this empirical strategy is to use characteristics of the borrowers and lender-borrower relationships that are plausibly exogenous to the contemporaneous supply system to identify variations in the instruments. And some of the characteristics that we use include distance between countries, historical regional waves of social unrest, historical population. And the key intuition is that countries that happen to be geographically closer to other countries or more populous or located in regions that experience less social unrest historically or are located near large banking sectors tend to have higher prices and lower interest rates. So in the remaining time, I will go through our results. So I will start by discussing the estimation results for within sector supply curves for interbank and non-bank loans. The coefficient on price shows that as price declines or expected return increases, banks supply more loans, both in the interbank and the credit market, which goes our intuition. The subsequent coefficient shows that banks are more willing to lend to larger countries that are closer to them, and they're more willing to lend to their own non-bank sector, reflecting some home bias. The result I want to highlight is the coefficient on price, which can be translated into supply elasticities. So our computation shows that a 1 percentage point increase in interbank rate leads to a 42% increase in cross-border interbank loan. So the corresponding elasticity for the non-bank is 13. So this estimate is comparable to estimates of elasticities for short-term debt that's in the literature.
So can you clarify what's the maturity? I mean, what's the price you're using? Usually we think banks, they tend to make more profit when the term structure of the interest rate is higher, because they are short. They are short in safe liabilities, but they are long in longer term assets. So we kind of think that it's when the term structure is more sloped that there will be more lending. So what's the price here?
So the price here is for interbank, it's the 3 months interbank lending rate. And
So
for
it's the very short term interbank.
very short.
What the
Yes,
overnight? What is
3 months.
3 months?
Yes. And for the firm, it's 1 year.
Okay. So that's not totally obvious to me, but okay. Okay.
So yeah, so we are not basically taking into account the full term structure. We're not taking into account the kind of the maturity aspect of the decision making here. And maturity is again another aspect that we could study. And I think this model could be augmented to incorporate this aspect. But here we're just taking into account a particular set of maturity, which is the most common type. If you look at a typical interbank rate and prime rate, these are kind of the standard maturities for these prices, and that's what we use.
Okay, but you were instrumenting. What were you instrumenting with your distance and so on?
I'm instrumenting the prices. So the instruments are, like I said, the distance across countries, historical wave social unrest, and items like that. And they're used to construct and implied prices from our structural model. And the implied prices are kind of instruments that ultimately are used to estimate these supply curves.
All right, and you have your results on your instrument, like the F-stat or any diagnostic on your instrument, how you are doing in terms of weakness of instruments or not, and correlation. You have?
Yeah, so yes, absolutely. I don't have it on the slides, but we have done F-stats and shown first stage graphs, and the F-stats are very high. So and we have done some variants of the instruments, and the coefficients tend to be quite stable, and that makes us kind of more confident in these instruments.
Sorry, so for the instrument, you said it's a fitted value. Isn't it very slow moving variables that you use to construct the fitted values for the instrument? Like, is there much variation in your instrument, time variation? Because you mentioned something like about where's the time variation in the instrument? I guess is my question.
So this empirical strategy is really relying on cross-sectional variation. And essentially we can estimate all these equations year by year and get the results. So what we are relying mostly is on the cross-sectional aspect.
So then I don't understand how the instrument, I guess the instrument is you estimating, because I thought it's by country, right? You're estimating it for a given bilateral relationship. I didn't understand you're not using the time dimension, right? So you're estimating it bilaterally by country, or I guess no, you're doing that cross section. Sorry, I missed that part.
I'm doing the cross section. So it's yeah, it's for the whole network. I'm estimating.
So there is no country specific elasticities here.
There is country specific elasticities. So there is
estimated year by year.
So here I'm estimating for the whole sample period, and I've also done estimations year by year. But so for this estimation strategy, ultimately the variation is at the cross section. We're not relying much on the time series component. And for the elasticity measures that I'm getting at the end, it is going to be bilateral. So lending from UK to the US, I'm going to get one particular elasticities for each of these bilateral relationships. And the characteristic variables are both capturing bilateral relationships as well as characteristics of the borrower countries. And so there is no heterogeneity on these aspects.
I guess I'm missing, when you said you are estimating it year by year or date by date, so you have one observation for the flows between UK and US, but you're able to estimate an elastic. I'm missing something, sorry, I'm missing some data.
No. So the year by year is kind of an analogy to explain that the main variation is coming from the cross-sectional aspect for the instruments. But what we are estimating here is throughout for the entire sample period.
So you have the time, you have a panel.
A panel, yeah. I'm just saying the cross-sectional variation is kind of key. It's kind of the main sources of variation. But our estimation.
Okay. Because yeah. I mean, Ruff and Cotters have different papers where they estimate it literally period by period, because then they have ISIN level data. So that's why I was getting confused how you're estimating UK, US elasticity if you had only one data point for one period. So that's why I was confused by that statement.
Yeah, sorry for the confusion. So we're estimating for the whole panel, and I'm just stressing the cross-sectional component. And absolutely, like if you're familiar with Ralph Moto's paper, we're kind of applying their estimation strategy. And as they have shown, like the mean variation is on the cross-sectional aspect, and they actually do it, for each cross-section.
Because you also started with the pre-post crisis kind of trends. So again, you're emphasizing in the motivation, the time series dimension and interesting thing happening over time. But you're kind of telling me that there is effectively elasticity specific to two countries that is pretty constant over time, because you cannot estimate time varying one.
Oh yeah, sorry. So for the time series aspect, what we're doing is we're running it by subsample by subsample. So we are running kind of a rolling regression for a 7-year window. And I am going to show both kind of for the whole sample period results and kind of the sub-period by sub-period evolution of these elasticity over time. So here, our results is both going to be kind of on the cross-sectional aspect, also in the time series dimension, and the time series is going to be done in a rolling regression form. Okay, so the results, I'll explain here. So let me dig a bit more into these loan supply elasticities. I'm spelling out here the full equation of aggregate supply elasticities for a borrower country. It captures the percentage change in total interbank or non-bank loan to that country when its corresponding lending price changes. It is comprised of terms that captures bilateral elasticities, portfolio weights that different lenders place in the borrower, and AUM of lenders. These two terms captures the willingness of lenders to provide intermediary services to the borrower, and the last term captures the capacity of the lender to lend. And to better understand the economics underlying the aggregate supply elasticities, I will dissect it. So first, let's examine the relationship between the willingness to intermediate and the portfolio weight using an example. Here I'm plotting out how the willingness of the US banking sector to provide intermediary services to different borrowers varies with portfolio weights it puts on different countries.
So what is we find the variable. I missed the definition of the willingness to lend. What is that parameter? Or
so it's this component. It's basically the bilateral elasticity component times the weight that country N puts in country N.
Okay.
So I'm plotting it against the portfolio weight, and we find a strong positive relationship. So the portfolio, if we recall from the estimation results of the willing sector loan supply curves, the portfolio weight that a banking sector puts on another country is dependent on the characteristics of the borrowers, like the GDP and default risk and the bilateral relationships. So banks' willingness to provide cross-border lending to a country is determined by these economic factors. And through this example, you can see that the US is most willing to lend to UK banks and firms, followed by Japan, then Canada. And now if we examine both the willingness and capacity of a banking sector to lend to the affected to see how that affects lending to the borrowers. As an example, let's examine it from the perspective of the UK banking sector as a borrower. So the x-axis plots the willingness of different foreign banks to lend to UK banks, and y-axis plots the willingness and capacity of banks lend to UK banks. So as shown here, well, both the US and Spain are equally willing to lend to the UK. The US has much greater capacity to do so. So as such, in response to any UK price changes, the total amount of funding that US lends to the UK and the marginal additional funding that US lends to the UK are both greater than those from Spain, despite the same level of willingness. So we have examined the components that make up the aggregate supply elasticities. Let's examine these aggregate elasticities across borrower countries in the global financial network. We plot out these elasticity by borrower country, and we find there is a significant amount of heterogeneity across them. So the left figure is the elasticity of bank funding due to the cross-border interbank lending. The middle shows the elasticity of non-bank funding due to cross-border lending, and the right shows total non-bank funding elasticities. So the right is accounting for both cross-border and domestic lending. So overall, as you can see, there is a lot of variations. And given these estimates, the key question we want to tackle is what do these heterogeneities mean for international risk sharing? Okay, when countries are hit with idiosyncratic shocks, does the network provide insurance to reduce the impact of the shock?
Leslie, just a clarifying question on the elasticities. What are the confidence intervals on those elasticities? Are they tight enough that you really can rank them that way, even statistically?
So what we have done is various robustness checks on our estimation results. And just trying variance of the instruments and variance of the different characteristic variables, and we find that they tend to be very stable. So that's one level of confidence. Then we have conducted some kind of verification analysis. One is we try to see if the exchange rate predictions from our capital flows goes with the estimates that's in the literature. Actually, we use the Helen paper on their portfolio allocation paper, and we find that the estimates tend to be similar. And then we also do analysis where we try to see if the bank capital flows that's estimated from our model goes with the stylized facts that's been documented in the literature. Whether a shock hits, emerging market experience much greater shock relative to advanced economies, and we indeed find that. So let's first examine the question I mentioned using a specific case of a 1% decline in domestic funding in the US. So the funding decline, you can think of it as a local funding shock. Right? It's a shock induced by any exogenous policy that lowers the amount of capital banks are willing to use to fund loans, such as monetary policy contraction. And the results on this slide are based on supply-demand curves estimated using one of the earlier subsamples of data, so from 2007 to 2013, and we call it the 2010 subsample using the midpoint year. Okay, so focusing first on the interbank market here. In response to US local funding shock, total funding in the US banking sector declines by 0.7% overall. That's about $0.8 billion. This total effect can be decomposed into a component that can be directly attributed to the shock, and this is what we call the shock effect, and a component that should be attributed to the global financial network, the global rebalancing effect. Okay, so the shock effect is just the 1% negative bank funding shock. The rebalancing effect captures foreign banks' endogenous reallocation of funding within and across networks in response to shock. So like the German bank in response to shock could reallocate funding from other banks or non-bank sector toward the US banks or away from the US banks. And our estimation shows that banks in the network reallocate toward the US banking sector in response, mitigating the shock by about 25%. So the global interbank rebalancing here serves as a mechanism of insurance. So here on the right, I'm plotting out the effect on the US non-bank funding. In aggregate, we estimate that loan provision to US firms declined by almost 0.4%. And this total effect can be decomposed into a shock effect, a global rebalancing effect, and a self-rebalancing effect. So the shock effect captures immediate change in lending to non-banks in the US, holding all countries' loan portfolio weights fixed. It includes both changes in lending by US banks and as well as higher order effects. The rebalancing effect captures reallocation in the cross-border lending by non-US banks to US non-bank sector in response to the shock. And the self-rebalancing effect captures two components. So this is the same graph. The self-rebalancing effect, the two components are, one is retrenchment. So that's the red component. This is endogenous reallocation of funding by US banks. And the the blue is the indirect global interbank effect. This is amount of global interbank rebalancing that are intermediated by the US banking sector toward its non-bank sector, right? So foreign banks rebalanced toward US banking sector when it was hit by local funding shocks. The US banks are able to intermediate these funds toward its non-financial sector. And as you can see, most of the self-rebalancing is actually coming from the indirect global interbank rebalancing.
Sorry, do you mind if I ask, what does this look for the period outside of the financial crisis?
So I'm going to talk about the time series in two slides. Yeah. So, sorry. So overall, the credit and self-rebalancing dampens the shock effect by about 50%. Okay. Now let's generalize this 1% local funding shock for each country in the network and study the amount of insurance through the three margins of rebalancing. The left figure here plots the amount of interbank rebalancing relative to the shock effect across different countries. And as you can see, now there is a large amount of variation in the degree of insurance, ranging from 6 to 60%. The middle figure plots the amount of global credit rebalancing relative to the shock effect, and ranges from 3 to 22%. And the right figure plots the amount of global credit rebalancing and self-rebalancing, so combined, relative to shock effect. And that ranges from 29 to 79%. So as clearly, the amount of insurance through the different margins of rebalancing varies greatly across countries. Okay. So what is driving these variations? I've shown that it is, it's basically the aggregate supply elasticities of each country and sector, which are determined by prices and characteristics of the borrowers and borrower-lender relationships. Okay. So the three figures shown here have sector-specific elasticities on the x-axis and corresponding insurance measures on the y-axis. The left figure illustrates kind of the share of interbank rebalancing versus the elasticity of interbank loan supply. The middle figure is the share of global credit rebalancing versus elasticity of cross-border non-bank loan supply. And the final one is a corresponding one for the share of credit and self-rebalancing. Now, as you can see, countries with higher supply elasticities receive more insurance when they face local funding shock. And this is because banks in the global financial network are more willing and have greater capacity to provide lending to them through rebalancing when their interest rates increase. Okay. So I've shown the heterogeneity on the cross-section, and I will move on to discuss how they move over time. So to do that, we estimate our supply curves using rolling regressions based on 7-year subsamples. And the plot here shows the time series of the supply elasticities of bank funding due to the cross-border interbank lending, the red line, and the non-bank funding due to cross-border non-bank lending, the green line. So our results show that loan supply has become less responsive to changes in prices since 2010. Most notably, right, the supply elasticity for interbank lending has declined by more than 80% since 2010. A 1 percentage point increase in interbank lending rate leads to a 19% increase in domestic funding due to inflows from in the global interbank market in 2010, but by the end of our sample period, the elasticity is only 3. And the supply elasticity for non-bank also declined from 2.5 to 1.7. So what are the implications of insurance? Then if we continue with this 1% US funding shock that I was showing earlier, and here what we're doing is we're comparing the results from the 22 subsample, which is shown in the dark purple bars, relative to the later sample, the last subsample of our results, which is the light purple bars. So focusing first on the funding to US banking sector, the plot here shows that the change in total funding and interbank rebalancing normalized by the shock effect. So as you can see, non-US bank reallocate a much smaller amount of funding toward US banks through the interbank market in response to the shock in the later period compared to the earlier period. And so the total effect of the funding shock on the US banking sector is now much greater. And for the non-bank, we see a similar effect, right? There's much less insurance. The total shock effect is much greater. The decline in insurance to US non-banks is mostly due to the decline in global interbank rebalancing. And the result, US have less funding to intermediate toward its own non-bank sector.
Leslie, I have a question, but you've only got a couple of minutes left. So maybe we let you finish and then we have questions at the end. How about that?
Sounds good. Yeah, I'm happy to stay around to answer more questions. So if we generalize this exercise for each country in the network, so if we apply the 1% shock, we observe that the amount of insurance provision have significantly declined for all countries in the network in the later sample relative to the earlier one. So here where you have 2010 on the x-axis and 2016 on the y-axis. So anything below the 45-degree line means less insurance. And we observe that for basically almost all countries. Okay. And finally, we explore one potential explanation for this decline in insurance over time, which is a change in regulatory stringency and wider use of macroprudential policy. Okay, and we capture these regulatory changes in these regulatory standards using data from the IMF. We're constructing a regulatory stringency index. So we first plot out the changes in stringency index against the changes in loan supply elasticity in the banking sector across countries. And the specific requirement we're focusing at is LCR because they tend to make short-term interbank lending more costly. And we find that more stringent liquidity requirement is associated with less elastic interbank loan supply. And here on the right, we're plotting out the changes in capital requirements against the changes in non-bank loan supply elasticity across countries. We also find a negative relationship. So more stringent capital requirement is associated with less elastic loan supply. Okay, so in conclusion, we provide a new structural model to dissect and quantify how heterogeneity in global financial intermediaries' willingness and capacity to lend contribute to international risk sharing. And we find a set of key results. There is significant cross-sectional variation in the willingness and capacity to provide intermediary services as reflected from the supply elasticities. Countries with lower supply elasticity receive less insurance in response to idiosyncratic shocks. Elasticity of interbank loan supply declined significantly since the global financial crisis. And that has resulted in less insurance provision and greater shock amplification in both networks. And finally, we show that greater stringency regulation is associated with this decline in insurance. And we are working on a new project that looks more into the welfare implications of bank regulations. So thanks a lot for your questions and comments, and I will happy to talk to you more about.
Great. Well, thank you so much, Leslie.